Alright, let's talk about the most overused, yet least explained phrase in investing history. Enjoy today's gameplay while I explain what people don't tell you, because it's way easier to just say, bro, do your own research. And as always, quick disclaimer, nothing in this video is investment advice. This is purely entertainment. Now let's clear this up. Look, we've all heard it. Do your own research. Okay, but what research? Google it? Read a tweet? Stare at a green chart and pray? To be fair, I do get why people say it. Explaining what proper research actually involves is a lot of work. It's nuanced, and honestly, not every industry or sector is measured the same. But there is a solid framework, and once I understood that, the phrase stopped sounding mysterious and started making sense. So let me break it down in plain English. First question you should ask, why this company? What stops competitors from copying them and eating their lunch? Do they have a strong brand, proprietary tech, market dominance? Basically, what I'm saying is, you should ask if they have a moat. If just any random startup with a logo and a LinkedIn page can replace them, that's not a moat, that's a puddle. Moats look different in every industry, but the best businesses usually have something protecting them. Next up, growth. Is the industry growing or slowly dying? You gotta ask yourself, is demand increasing? Are there strong tailwinds? Is technology adoption helping? At the end of the day, investing in a shrinking industry and hoping for miracles is not a strategy, it's cope. You want businesses riding waves, not fighting tides. Thirdly, we have valuation and margin of safety. This one's important. Just because a company is good doesn't mean it's a good investment at any price. And please, for the love of all things holy, stop using P/E ratio alone. P/E by itself is like judging a car only by how shiny it is. If you do use it, compare it to sector averages. Compare it to competitors. Factor in growth rates, CapEx, profit margins. Side note, I personally think MarketBeat is a solid free tool for quick comparisons. Valuation is about what you pay, not just what you buy. After that, we look under the hood, the financial health of the particular business. Ask yourself, does the company have manageable debt, healthy cash flow, a solid balance sheet? Because great ideas still fail if the finances are trash. A business drowning in debt is like someone living paycheck to paycheck. Just one bad month and they're screwed. You want companies that can survive downturns and invest for growth. Okay, this next one gets overlooked a lot. Who's running the show? Who's managing the business? Ask yourself, are they experienced, transparent, known for value creation, or value destruction? Because if management has a history of burning money like it's a bonfire, don't be surprised when they do it again. A quick look into the CEO or leadership's past can tell you a lot. Now, you don't need to stalk their ex on Instagram or find out what their favorite color is. Just a brief history of their work, because you will find trends. Sometimes a new CEO or deputy comes in and they have a solid track record, and this is very bullish. Alternatively, if a new management team or lead has joined a business, but the last 3 or 4 businesses they worked with filed for bankruptcy, or they kept diluting shareholders, I'd be very cautious personally. Alright, the next factor worth a mention is risk factors and downside. This is where people get lazy. Everyone loves upside. Nobody wants to think about downside. You want to think about stuff like regulatory risks, competition, execution risks, and industry disruption. Some people even create a simple risk score or matrix, weighing probability versus impact. I'll be honest, I haven't fully formalized mine yet either, but even thinking about risks already puts you ahead of most people. Profitability and cash flow. Next up is profitability. Are they actually making money? And I don't mean accounting tricks. I mean real cash flow. See, it's easy to skew values on a balance sheet to make things look fine and dandy, but you have to peel back some layers to understand what's really going on. So you want to ask yourself, do they generate consistent profits, produce free cash flow, survive tough environments? I often look at how companies handled during the COVID era. Stress reveals character. A business that survives that kind of chaos deserves respect, in my opinion. And finally, what are the growth catalysts? Look at new products, expansion, innovation, strategic shifts. Because you're not investing in the past, you're investing in what comes next, and catalysts give your thesis direction. So there you have it, doing your own research simplified. It doesn't mean blindly trusting Reddit, buying hype, copying influencers. It means understanding the business as well as the risks and understanding the valuation. Only then deciding if it fits your goals and tolerance. And no, you don't need to master all this overnight. Research is a skill and it compounds like everything else. So next time someone says, do your own research, you'll know what they actually mean. As always, take care and see you soon. Alright, before we wrap this up, if you actually want to level up your due diligence and surround yourself with other young, hungry lions in the investing space, feel free to join the Discord. I'm building an open, honest environment where people can share ideas, ask real questions, and actually learn how the market works, without the fake gurus or flashy nonsense. I also post all my real-time trades, plus detailed stock reports for my long-term holds, so you can see exactly how I'm thinking, not just the results. 2025 was an absolute amazing year. The Discord portfolio averaged around 30% return. Our biggest wins, such as Google and AMD, both doing over 100% gains. ASML Holdings, Sezzle, and First Solar doing around 40 to 50%. For comparison, if you just dollar cost averaged into the S&P 500 over the same period, you'd be looking at roughly 7% average weighted return. Will we hit crazy numbers like that every single year? Of course not. But it does show how powerful learning, patience, and proper due diligence can be when you take this seriously. So if that sounds like something you want to be part of, join us. The link's down below in the description. Appreciate you watching, and I'll catch you in the next one.